Hello? Hello?
Good morning, everyone. Good morning to viewers in cyberspace, those watching on Facebook, Zoom, YouTube. Welcome to Sygnus at Breakfast. This is our flagship program where we look at topical issues that affect the capital markets and investments. And today, or this morning rather, we will be looking at alternative investment from various perspectives. As an alternative to the traditional banking, finance, and such like, we're going to look at alternative finance as an option to finance companies to grow their businesses, as well as to portfolio managers to increase their portfolio to these types of asset classes. And to discuss all of this, we have assembled an esteemed panelist of persons who are expert in their respective rights. From Portland Equity, we have Mr. Robert Almeida, who is the managing partner. Rob has been a career banker with CIBC before he went to join the Portland Group, where he is a co-founder of Portland Equity, and he has a wealth of experience not only investment banking, but also in private equity. And so he will give us a perspective from why alternative investment is important, and also talk about new trends and so forth. Also with us is Mr. Alexander Melville, who is the managing director of Chukka Caribbean. As you know, Chukka Caribbean is one of the leading adventure and leisure companies in Jamaica. And Chukka Caribbean also, as a group, is part of real estate through diverse asset, which is also an alternative investment asset class, as well as retail services. Also from Portland, we have Mr. Ricardo Hutchinson, who is a vice president at Portland. Ricardo is also a career banker, having worked with CIBC and Citibank in investment banking and credit, and now he works along with Rob to drive the Portland equity business in the Caribbean and Central America. And last but by no means least, Mr. Beresford Gray, the CEO and co-founder of Sygnus Group, and he will give us a perspective of the journey of Sygnus. How is it Sygnus managed to become a leading player in that space, and also give his views as what we can do to grow this space in the Caribbean, along with other stuff and exciting things that he have in store for us. So, without any further ado, I'll ask Mr. Robert Almeida to lead off. And the question I'd like to ask you, Rob, is, and what is the role of the alternative investment ecosystem in the global financial markets, and what do you think we in the Caribbean need to do, regulators, fund managers, to grow the space and to get companies looking to this form of financing to grow their business?
Thanks, Gregory, and thanks for inviting me to participate in this distinguished panel. The way I think about this is, if you think about global growth, and just growth of any economy, private businesses are effectively the engines of growth in the global economy. The majority of growth is created by private companies. And so the role of the capital markets, the role of financial markets is to figure out how to get the savings of people, which is primarily today in institutional pockets, in pension funds and insurance companies, and to enable that capital to make its way to the engines of growth, which are private businesses. So the challenge is that private businesses, for the most part, would have a number of attributes that, quote unquote, make them uninvestable. And what I mean by that is the sources of capital tend to look for scale. They look for a large investment. They look for linearity. They look of returns. They look for liquidity, daily liquidity. And so, and yet the very inherent nature on the other side of a private business is it doesn't have those things. We've codified that in a framework that we call 3 preconditions for creating wealth. And those 3 preconditions are: there's a perception reality gap between basically the investor looks at it and says, I don't know how to invest in this asset. And on the other hand, the private business, which is actually the future Apple or Amazon or, you know, a future unicorn type business in the world. Our job is to, as private equity as an alternative asset class, is to make those uninvestable businesses investable. And that's how I think of it as the ecosystem. The ecosystem are the investors, the institutional capital, and the best returns are going to be in the private businesses that are out there in the world. And then there's a private equity ecosystem that plays a critical role in enabling country growth, and enabling community growth, and enabling the betterment of society. And all of it is focused on getting that capital to migrate into those private businesses, and making those private businesses more investable, helping them to be investor friendly, so they're trusted by global investors, so that they actually have the ability to scale, so that they have the ability. They're nascent businesses very often. They're small. They don't have extensive resources, but the institutional investor would like to see a business that has access to all the resources that a large company does. So the private equity space, the private equity ecosystem of investors or managers like Portland Private Equity, like Sygnus, like others, it brings that scale, that access to resources to them. It brings a voice in the system to these businesses, but it also makes them investor friendly, which makes them more accessible to the institutional investor class, which is where most of the assets are held these days.
Okay, Rob. So, how do you make a case to fund managers in Jamaica and by extension the Caribbean to increase allocation to this asset class? What are some of the benefits in doing things like these?
So Craig, this is a really, it's ironic that this question always gets asked. So the role of an asset manager, a fiduciary, is to maximize returns for the investors, and maximize risk-adjusted returns. So what you have to look for is you have to look for ways to reduce risk and increase return. And ironically, the very things that exist in public markets, or in particular, you'd almost look at like a bond, a public debt, is the rigidity of it. The lack of flexibility actually introduces more business risk to the recipient company. So as we're now seeing in all parts of society, the buzzwords are adaptive, pivot, adjust. All of that is the buzzwords of today's economy. And so it's all about flexibility. And so flexibility actually reduces risk. So we talk about, so what's in it for the investor? First of all, diversification. Because it introduces more diversification enables better risk-adjusted returns. So that's the first source of added value for a portfolio manager. The second source of added value for a portfolio manager is an illiquidity premium. Private assets trade at a liquidity discount. So whatever you do with your valuation, you then apply a 10, 15, 20% discount to it and call that the illiquidity discount. The inverse of that is it's a return premium, an illiquidity premium for the investor who doesn't need the money the next day. And that's another source of excess return. The third source of excess return is the active management that takes place in private equity. The fact that you actually overcome those three preconditions, the fact that you buy something based on a perception, which is not as good as the reality, or you're able to add value to the company. So you're able to take a company that looks like a small company, but make it act like a big company. You're able to work with a company that maybe lacks financial expertise, lacks some operational expertise, lacks some sales expertise, and you're able to plug that hole. And by doing that, you make it a much better company. So there's a return on active management. So for portfolio managers to pass up on those three sources of excess return is actually going against the very mandate that they have. And to put a benchmark to it, globally, institutional asset managers probably have 20 to 40% in the private alternative space. When you include hedge funds, probably 50-odd% in alternatives.
Great, good stuff. So, Mr. Beresford Gray, Sygnus has managed to become the leader as an alternative investment platform in the Caribbean. Tell us about this journey and how is it you're able to lead the Sygnus team to achieve such a feat in such short time, just so under 4 years.
Thanks much, Greg, and good morning to everyone, and welcome again to Sygnus Business at Breakfast. Sygnus was launched 4 years ago, really, and we had a very deliberate strategy. Our strategy was designed around filling the gap, and the particular gap that we know that we could contribute to in terms of the financial ecosystem in the Caribbean was the alternative investment market. And why? The reason is very similar to what Robert spoke about. How do you increase the velocity of growth within the economy, especially amongst medium-sized firms that will translate into large firms in the future, and to a certain and unicorns in some instances? And how do you increase accessibility to capital? When we think about what Sygnus is doing and what Sygnus is fundamentally designed to do is basically to create accessibility to capital primarily through the alternative space, so that capital can flow through different, let's say, risk habitat, whether it's private equity, private credit, or real estate, or other forms of alternative capital. We want to basically create different channels, and let's say channels where investors playing in those channels of different risk appetite. There be investors who are interested in credit risk, and hence they can participate, for example, in Sygnus Credit Investment, which was our first investment vehicle that we launched. There are investors who are keen on real estate risk and the returns associated with that, and they can participate in our real estate investment vehicle, Sygnus Real Estate Finance. Or they can be interested in private equity, and there they can participate in Sygnus Deneb or other private equity vehicles. So that was our philosophy. What we did over the last 3 to 4 years is then to underpin that thinking with a number of things. The first thing was an investment philosophy that really have about 4 key pillars. 1, we want to focus on attractive risk-adjusted return for our investors. 2, we want to embed a strong risk management culture so that we protect downside for our investors. So effectively being good stewardship of investor capital. 3, we want to have a strong governance structure so that there is a significant amount of independence and what we call integrity, which is very important. Integrity in the decision-making process. It's very important in any financial institution that there is trust and integrity in how decision is made. And if you have a strong governance process, that will help you to make the right decision most of the times. and that's what we want to do. And finally, we want to leverage our expertise, and by leveraging our expertise, and we have an absolutely strong team at Sygnus, it allows us now to basically bring what a lot of persons heard and probably know Sygnus for: creativity, flexible solution, customized solution for our clients that are focused on really addressing their needs in a very partnership-like approach. That's all about leveraging our expertise. Our expertise in investment banking, M&A, fund management, risk management, wealth management, tax advisory. So we layer on those philosophy on the business model. And today, we are very proud about the achievements so far. We still have a lot of work to do because at the end of the day, we are part of an ecosystem. We have many other players who we work closely with. We're also part of the Caribbean Alternative Investment Managers Association. In fact, we were one of the founding members. And the reason why we did that was because, like the other players in the ecosystem, we are very passionate about the importance of this channel for investors on the one hand and for corporates on the other hand. So it's trying to satisfy investors' desire to have diversified, better returns in their portfolio, and corporates on the other hand to have flexible capital, helping them to solve their needs.
Well said. As a follow-up to Rob's question I asked earlier, there are pension fund managers, asset managers, regulators who are probably tuning into this webinar now. What are some of the changes you'd like to see in the market from investors, regulators, to increase and grow this space, make it more easy for businesses to access this type of capital, and also for pension funds and other asset managers to increase their asset allocation?
Yeah, very, very good question, and it's a very important topic to discuss. And because we have a very broad and what we talk a lot at Sygnus about infinite organization, creating an infinite organization, which is what we are doing at Sygnus, which means something that goes beyond the now and transform the space that we are in. We are very patient but want to work with a lot of velocity. And to that point, as Rob said, in the global market, alternative capital represent 40% of investors' portfolio, institutional investors. Right now in the Caribbean market, it's probably way less than 1%. As a matter of fact, the current regulation, which we are grateful for the incremental changes that took place a few years ago, probably 2 or so years ago, which allow pension funds to carve out about 5% of their portfolio for private debt as well as alternative asset, private equity.
Right.
That's a very small percentage when you talk about 40 or so percent.
Correct.
Which means that if we are, as a country and as a society and as a region, really serious about how do you unlock capital to flow into medium-sized firms and private company, big businesses at a greater velocity, then we have to look at, over time, how do we increase those levels. And the main reason I said over time is because, in all fairness, in institutional investors, pension funds, high net worth individuals included, endowment funds, etc., they are still learning how to invest in alternative funds. They are still getting used to, investing in a Sygnus credit investment or a Portland or so, and then hear that, hey, when you invest in private equity, you won't get back your cash until 5-7 years when we wind up. Or, we are going to take your capital and invest in private company which are liquid and try help them to enhance value. They are still getting to understand that type of investment trajectory. So I expect, and I would sort of push and ask the authorities to, think about how do you get capital to flow into the alternative channel which is a key channel to drive the velocity of growth in any economy. Let me just, Greg, and let me digress a little bit. In 2020, during the crisis, the global capital, meaning flows from institutional investors that went into alternative investment, private equity, private credit, private infrastructure, etc., was about $850 billion in the middle of the crisis. US was approximately 500 billion, and Europe 250 billion, and Asia and LATAM made up the rest. Why do I say that? I say that because if you think about last year, the amount of capital that was raised by alternative fund managers in Jamaica, it was, I don't know, probably $70 million. You know, if you look at ourselves, Proven, etc., it's probably $70 million in a crisis. And alternative investments are best needed in crisis to complement the traditional financing. So when the banks retreat, and they rightfully should do that because their risk metrics are a little bit different than ours, then our companies survive and position themselves to take advantage of opportunities within a crisis is through alternative investment. So I'm just making that point to say we are still a way off from where we want to get to. Thank you.
Well said, Beres. And just to follow up on that, I'll move over to Alexander Melvin, who is the Managing Director of Chukka Caribbean and has been a trusted client of Sygnus Group since inception. So, Xander, tell us about how using these type of financing has assisted your company to grow and to navigate the current environment. Beres mentioned that in a crisis, these are the type of financing you need as opposed to, you know, the traditional bank loan. Tell us about that journey.
Yeah, thanks. Thanks very much for having me, and great question. I would clarify, I'm really the Treasury Director for Chukka Caribbean, but Managing Director for our parent company, which Portland Private Equity is actually an investor in as well, Diverse Assets. And our company has kind of three legs, the tourism, real estate, and of course, tropical battery. So how it has helped us? I mean, our journey was transition from a family business to private equity investment, say 4 years ago in 2017. And we used, so we would, we're an our relationship, we're an investee. We received investments from private equity, and we've used those funds to pretty much do exactly what you guys just said, which is to grow. And it's a beautiful thing in that where banks sometimes don't want to take certain risk because you may have had some challenging years in your business, then private equity, the use of instruments, creative bonds that we have raised through you, it's fill that gap, allowing businesses to grow. And the main thing I would say is really it's the flexibility of these bond structures, it's the speed at which it can be done, and also the cost is very very competitive, and in many cases lower, because you're literally going direct. You are putting direct investors with the company, which other banks sometimes there's a margin in the middle there from traditional banking. So you're getting good rates, the flexibility, and this really allows us to grow our business, because the traditional loan structure is one where you're paying interest and principal, and that principal is eating into your working capital. That principal under the bond structure, you use that principal to grow your business. So you're servicing everything with your interest costs, and then instead of paying down that principal, you can then use it to grow much quicker. So I think growth is the flexibility in those products is really a great niche and has been helpful for our group of business.
Excellent. The Chukka Group is a very unique group. It involves, as you said, real estate through Diverse Asset. There is Tropical Battery, which is the retail product sales, and of course the Chukka Adventure, which is hospitality type play. So like many other businessmen and companies, you would have been impacted, you know, not as severely as some, but maybe depending on which part of the business you're looking at, by the COVID-19 pandemic. How have you managed to survive? Were there any unexpected wins? Were there new products and services that emerged by trying to adapt to this new paradigm or seismic shift brought on by the pandemic?
Yes. So how did we survive? A lot of questions in there. We accessed bond facilities, which gives us the time to get through the pandemic. And I'm just talking really our tourism business. Luckily, our real estate business had its best year ever. In the middle of the pandemic, we also listed our what we call energy storage business, Tropical Battery. We're one of the only, I think, 1 or 2 IPOs that happened in 2020. Right. And those businesses, I would say, you know, obviously tourism, hospitality, the worst impacted. Right. We had no revenue for 8 months. And Tropical, medium impact. Our revenue was up, but profit was down. And our real estate business actually had its best year ever, something like 200-300% profit up from the prior year, 2020. So I think that, you know, it really impacted us in tourism, but again, the built-in flexibility of being able to access funding to get us through startup, 1, and 2, the flexibility of being able to negotiate with our bondholders and say, okay, this is a once in a 100-year event. Yeah. We need a little breathing room on the interest payments, and we were able to shift those to get a moratorium per se on those, which I think, you know, makes sense for both parties. And so that flexibility that's built into the product was very helpful, and that's kind of how we got through the issues there. What have we done to improve the company? Is we took those 8 months, and we have an incredible team, Mark Melville, John Biles, you know, a whole team, a finance committee that really, and a team on the ground that really we invested in technology during that time, during those 8 months. So when we start back, our business is actually going to be more profitable, and we have started back. Hotels are about 40% occupancy now, but not much else on the cruise line until probably cruise should open in about July. And so I think that we've increased the price per person that we're gotten during this time. And so we should start back much more profitably and much more, you know, in line with, because of the access to these facilities. So we took that time and used it pretty productively. So thanks.
Very good. So let me jump back to Rob, because I think he has a 10:30 that he has to go to. So let me just get him before he goes, and Ricardo can continue for him since they're both from Portland. So Rob, just a follow-up to Xander's question. How has the pandemic affected your portfolio companies across the various sectors and countries in the Caribbean and Central America? And what is the outlook and timing for the recovery?
So I'm going to start off, and then I think it's about how you, probably one of the benefits of private equity is you have to think long term, right? Yeah. So Barris mentioned, you know, you're talking about something, you're trying to get the investor to understand you may not get your money back for 5-7 years. The benefit of that type of thinking is when you invest in a business, you can only invest in a business on the assumption, you have to ask yourself the question, will this industry be around in 10, 20, 30 years? Will this region, this market be around in 10, 20, 30 years? Will this business be adaptable and adapt to changing technologies and innovations and all the other evolutions? Will it withstand the shocks of natural disasters? Will it withstand the shocks of, as we've seen now, a pandemic? Will it withstand the changes of climate change? And what's its relationship to climate change? So you have, because you're working in something that's long term, by definition, you have to think long term. And when you think long term, the good news is you actually invest in resilient businesses. So as Xander talks about, if you look just at the diverse assets business, he very quickly said, look, we had 3 business lines, one in tourism, one in real estate, and one in energy storage, tropical battery. And that diversification really helped diverse assets. Similarly, at the Portland private equity level or Portland Caribbean fund level, we've got a hospitality business, we've got a tourism business. They would be adversely impacted. We have an e-grocer business in Colombia that is just had a phenomenal tailwind in terms of growing. It's just e-commerce in a massive country like Colombia. It's actually expanded to Mexico and Brazil in the middle of the pandemic. The hospitality business, I wanted to stop the bleeding, is in the process of expanding to the United States from Colombia. But at the same time, we've got electricity business, telecom business, PBS in business services. So the diversification, bottom line is the diversification helped. And so 2 things. One is each business in and of itself is thought of as, will this business be around for 20 years? So that's how we have to think about it before we make the investment. Yeah. The second is the portfolio itself is diversified, and that provided us, has made it very good. And lastly, active management. I just can't understate how important active management has been in terms of, probably the best example is Chukka, because it's a combination of a voice in the system. John Biles has been very active in actually spends probably more than half his time working on the tourism industry in Jamaica, and what is that ecosystem, and leading the protocols and a resilient corridor and a variety of things. So it's actually about having a voice in the system, working on the financings that Xander mentioned with a Sygnus and with other parties, and working just at the operational level. And we've got to put in contactless technologies. We access resources through the German Development Bank that provide us some technical assistance in looking at some of the protocols, the COVID protocols that we could implement at the adventure parks. So leveraging the entire platform to reduce the impact, and at the same time actually look for opportunities for growth. So in summary, 3 things: diversification, a long-term perspective surely helped, because every one of the businesses actually is being very resilient. And lastly, leverage the platform that we have, the large platform, to have a voice in the system, access resources, and pursue growth opportunities.
Excellent. So Rob, I know you have to go now, so thank you again for taking the invitation to be with us this morning. You surely enlightened us, and your experience came to fore, and we are so much happier that you're able to make it, and we look forward to seeing you sometime again in the future.
Thank you very much, and I look forward to being there in person. Boy, it'd be nice to be back to Jamaica soon.
Excellent.
Okay.
All right, good stuff. So Ricardo, maybe you can pick up from where Rob left off, because it is said that the private equity stages involve origination, fundraising, monitoring in various portfolio companies, and of course, harvesting and exit. How has the pandemic affected those processes for you?
Thanks, and morning. Thanks, Greg. So, like most other companies or most other institutions, we would have been impacted on all fronts. Our portfolio companies, all, as Rob mentioned, would have been impacted. Some good, some bad, some ugly. And, we were at this stage in some of those companies where we're looking at, harvesting. With private equity, you go through a process. You initially raise funding. You're going to go through an investment period where you're essentially earning negative returns. You're working with a company, and then you move into your harvesting period. For our second fund, we would have started in 2014. There's a 5-year investment period, so we just finished our investment period, moving into our harvesting period when COVID hit. So what that did was to essentially delay some of the exits that we're looking at. And so from an exit point of view and an harvesting point of view, I'd say that probably delayed maybe a year to 18 months. Okay. On the fundraising side, because part of our business is essentially, you start a fund, you grow that fund, and you start another fund. So one of the things we're in the process of is looking at raising our third fund. Our first two funds would have been our limited partners, our investors in the fund would have been some of those development institutions. Right. For those institutions, their focus would have changed somewhat with the pandemic, and now they were looking to essentially help out institutions. So their private equity arm would have essentially been sidelined. So that would have delayed our fundraising efforts as well. But we're seeing now with, hopefully we're looking at the back end of the pandemic, we're seeing a bigger push on that front. So that's pretty much from, our harvesting and then our fundraising. As it relates to, how we work with our portfolio companies, we see ourselves as a growth fund. And as a growth fund, essentially, you're looking to work with entrepreneurs in terms of making sure they're focused, helping them to exploit any inefficiencies along the way. And also, most people would see, private equity and think all private equity does is provide funding. Now, that's critical in a pandemic, having the ability, having the flexibility to be able to help your portfolio companies, but that's only half of the story. Right. The bigger portion, when we look at private equity, our big focus is essentially make the uninvestable investable. That's where you're going to create value. And so we have to work with them along the way, making sure there's financing, but also when it is that you have a thing like a crisis, once in a 100-year event, then working with management become even more critical. And so we pride ourselves when we're looking at every investment, we make sure, we have a framework that we follow. And part of that framework, we have 5 things that we look for, 5 laws that we look for in any entrepreneur that we're investing in. And so we look for these 5 laws with those investors. If you look at, we make sure that they're, own operators, they can essentially, they know their business, these businesses are domiciled in strong long-term growth industries. And because we form that relationship with the entrepreneurs up front, when you have a crisis, it allows us to be able to work with the entrepreneur, work with management to ensure that, they put the policies in place to be able to survive a pandemic. You look at, as Rob mentioned, Chukka, for example, when we're looking at Chukka, which was, how often do you find a company that moves from, looking at growth, looking at expanding throughout a region, to go into a point where you have 0 revenues? And certainly it became a big challenge. But what we knew is that we have to be able to survive to the very end. And so, we've been working closely with the management. In fact, we're on weekly calls with the Chukka management team to ensure that they can survive this. So we pride ourselves in working closely with management to ensure that, they can survive through crisis.
Excellent, excellent. So Beres, we know that Sygnus would have also been affected by the pandemic. So there are some stuff that, you had to manage internally, but you're in a unique position because there are clients who would have called upon you for assistance as well. So not only you have to take care of your own house, as the saying goes, but you have to look to clients. How has Sygnus managed to assist and help clients navigate through the pandemic? What sort of assistance was Sygnus able to give?
Thanks, Greg. I think, again, the pandemic was and it's still a pandemic going on anyway, because even though we're getting vaccine. But for us, we are long-term investors, and we are vested in the region, we are vested in the alternative space. And by definition, one of our philosophies is establishing long-term partnership with our clients. I.e., what does that mean? It means that when we invest in a business, we are not only giving them financing, and we will do creative solutions because that's part of our DNA, but we also know that when we invest in a company, as Ricardo pointed out, you're really investing in the management team and the entrepreneur. That's really it. You know, a lot of persons like to phantomize businesses, but for us as investors, you're talking about, you know, if we're doing private credit, who are the persons running this business? What's the caliber of their management? What's the caliber of the team? And what's the caliber of their character? And that allows us to, once we answer those questions, when you have a crisis like now, it allows us to sit with managers and business owners who we invest in, and in some instances, realign in terms of redesigning financing structures. There are instances over the last 12 months where we have portfolio companies who needed working capital, so we provide that working capital support because we know they are fundamentally good businesses and those businesses are going to bounce back. There are other companies who wanted to expand because, you know, entrepreneurs are people who see opportunities all the time, even when it's crisis. So those persons, we have to provide them with acquisition financing. So at the end of the day, you know, we look at every company in a unique way, analyze what the needs are, look at our capabilities and try to align that with the company needs. And that's how we've been working over the last 12 months.
Excellent, excellent. So Zander, from a client perspective, there's a lot of talk and debate in the market around the timeline for recovery, especially in some of the sectors that you operate, which are key sectors to the Jamaica economy. These are tourism, hospitality, and real estate. From your vantage point, what is the outlook for these business lines? Where do you see tourism coming back, in particular stopovers and cruise lines? I know you talk with the cruise line persons all the time. What are they saying?
Yeah, good question. They are definitely, want to get back going. They are, the latest is that as of July, the cruise industry should be allowed to really kind of get going. And I think it's just, 95% of the persons on the ship who have to be vaccinated, but they're literally going to start back probably midsummer. And that I think is going to be, very positive for our business and for the country and for many countries in the Caribbean, because probably 50% of all global cruise shipping happens in the Caribbean. So I think it's a very important move that they get this done by the middle of July. So we are gearing up from the hotel side. It's open, and I think they're about 40% occupancy now, or 40% of kind of last year in terms of hotels. And that's coming from about 10-20% a few months ago. So you can see the trend is moving up. And I believe by summer they're going to be around 70%. The trends are looking like around 70% of last year of occupancy. So I think, I think there's a very positive outlook in terms of tourism hospitality. I think also the other thing, I think that's, as you said, from a real estate perspective, interest rates are low, historically very low for Jamaica and globally. Interest rates will probably, all global, central banks are forecasting all the way till 2023 that they're going to continue this low interest rate environment, giving people time to build their businesses back, or opportunities to take advantage of opportunities that low interest rates provide. So this is generally very good for real estate and equities when you have low interest rates for a good time. So I think the outlook is very, very positive given this low interest rate environment, and also the vaccine that by middle of summer, I think most things are, it'll almost be back to normal in some way, shape or form.
Excellent, excellent. And just before I wrap up this segment, because immediately following this segment, we'll have our question and answer segment. So participants can text in their questions and our panelists here will address them. So Beres, I'll give you the parting shot before we segue into the question and answer. You have been a investment banking professional for 20 years or more. You would have seen many a crisis, you know, the global crisis in 2008, would have seen debt exchanges locally, and now the pandemic, which had brought on what we call the global health crisis. Apart from persons dying unfortunately and sick and so on, from a economic point of view, and the loss of capital and companies going bankrupt and person losing their job, is the current crisis as bad from an economic standpoint as it was in 2008?
Well, that's a very good question, and it's always difficult to draw a parallel with crises. The reality is that this crisis started out very bad relative to 2008, what we saw in 2008, right? Because it was caused by a health issue, and then it disrupted every sector across the economy. So that when you look at our economy, for example, we collapsed in one quarter last year by over 11%. Mm-hmm. If you can imagine, and a lot of persons really don't think about it this way, if you can imagine Jamaica growing by 11% in one quarter, and then you put a negative sign to that, that's sort of the impact that the country experienced in one quarter because of the crisis. But with that said, though, we did not see the type of fallout in the global financial markets that we saw in 2008, which basically mean that there were more concession made for businesses to survive, and as a consequence, we are seeing that today where the rebound is much quicker than 2008. So, for example, 2008, Jamaica was really, the global crisis took place in 2008. Jamaica was really catching on in 2009, 2010, right? We were really late to the party, but the impact on us was immediate here. Tourism closed down, FX flows closed down, etc. A lot of job losses, etc. But the bounce back is much quicker. And let's take the reality of why I say that. If you look at the growth forecast for even Jamaica, we are looking to grow from the decline last year. Plus, by the end of the year, the capital markets start reopening again, such that you had IPOs and APOs, not a lot. Right. In the global market, though, by the fall of last year, you had some of the largest IPOs, and the market continued to be bullish, especially on the tech side. So I would say that the crises are there are different crises, but I think because the economy is scheduled, even when you think about vaccine and medicine and the transition to technology, working from home, and the capacity of the economy to work from home, the capacity of the economy to still have logistic and distribution going on, whilst we're going through a crisis. The adaptation certainly of the local and global economy is much more robust than what happened in 2008. So from that point of view, I see, and a lot of the pundits see the global economy, and by extension the local economy, rebounding much quicker than previous crisis, just because of technology and the ability to scale those technology.
Excellent, excellent. So now we move into the question and answer segment. And
okay, we are going to take our first question from the Jamaica Observer.
Okay, I have a question for each of the panelists. Did I go with all three questions or one after the other? Okay, for Mr. Gray, your APO last year, you mentioned that you needed the funds for write-down debt as well as capital deployment. Since subsequent to the APO, have you taken any equity position anywhere throughout the Caribbean? 1, 2. Also, what has been your capital deployment since then? And 3, what's the extent of your debt position now?
Okay. Great question. There are some elements of your question that I can't answer specifically because we're talking about Sygnus Credit Investment, our private credit company that did the APO, and they're a public company. So I don't want to say material non-public information, but I can answer you specifically. And just for the audience, let me clarify that the capital raise and the capital that Sygnus Credit Investment use focus on debt instrument credit. It doesn't take equity position in companies. That's done by our private equity company, Sygnus Deneb. Okay, so yes, since we have raised that capital and we are, again, can publicly say thanks to all the investors who participated in that APO. You know, it was a difficult time, but, you know, great businesses can raise capital in tough times. We have paid down the debt that we are, the bridge financing that we had committed to pay down, so we have paid that down. And since then, I would say Sygnus, we had a pipeline when we went to market, and we have been executing along our, I would say, usual or even better execution path.
Probably no more because I know I won't get a direct answer. Anyway.
Well, because it's a public company.
And the caveat.
Yeah.
Okay, yeah. Mr. Melville, even though you're going through hard times, your company has been bullish. If memory recalls, you did do some expansion in the Caribbean last year.
Yeah.
Right. So the fact that you have been bullish, the fact that your real estate investment, the real estate entity has best year ever, 200 to 300% up. Question, how soon do you expect to come out of the red given your bullish outlook?
So again, 3 separate businesses. The property company, real estate business is not in the red. It's in the black.
No, I mean,
yeah.
the group itself.
And tourism, by the end of this year, will be out of the red. And I think, yeah, I mean, it will be out of the red by the end of this year. And I think that we are extremely happy with what we were able to achieve. There's certain things in our business that we could not have done if the actual business was still running. So we now have digital electronic waivers that people sign that used to be paper. We used to have brochures, so printing costs. Now we have electronic brochures. We made a lot of investments in technology that as the business is restarting now, we're seeing those benefits in our profit margins going up, even though it's less people right now in tourism, but the profit per person is much higher than it was before the pandemic. So we think those trends will continue and those investments that we made will pay off. So yeah, we'll be out of the red by the end of this fiscal year, which is September for us, and back into profit in next year.
Okay. Alex, no. I'm trying to get the name. Ricardo.
Sorry.
Right. You're... Oh, sorry. Mr. Your MD, Mr. Well, I don't want Rob. All right, he had mentioned about expansion in Mexico and Brazil.
Yes.
Could you share some details about those expansion plans? Secondly, you mentioned about the fundraise being delayed. Could you give us an idea of the volume of the fundraise you're looking at? One. Secondly, the industries, areas you're targeting with this deployment of capital. And can you tell us the amount of capital that is being looked at and the method of fundraising you're looking at?
Okay. So I'll take your first question was about growth into Mexico and Brazil. That comment was really in relation to one of our portfolio companies, Merkeo, that's currently in Colombia, and it's an e-grocer business that during the crisis would have seen significant uplift with the growth in online shopping, and they're presented opportunities for further expansion into Mexico and Brazil, which they've undertaken. As it relates to our fundraise, we're looking at moving on to our third fund. From a target size that, it's something we're still looking at, but we believe somewhere in the region of 350 might be that number. We will remain a sector agnostic fund that effectively we will be open to any sector, any country within the Caribbean and Latin America region. We have a codified framework that we will stick to, and so whichever industry presents opportunities, that's where we'll be looking at. Your final one was on the method of fundraise. It would be similar to our previous funds. We'll be looking to raise funds from existing LPs as well as investors, local, regional, and internationally.
I'm assuming it's 350 million
US dollars.
billion US.
That's the overall fund at PJX.
Any more questions coming in?
Yes.
Yes.
All right, to Barris, how do you consider environment, social, and governance performance management when undertaking alternative investments?
Okay, yeah, that's a very good question. So ECG, that's basically the terminology for that. ESG. And ESG is a big part of alternative investment nowadays, basically impact investing. And for us, we are working to institutionalize a ESG framework within Sygnus. But at the moment, even without fully institutionalizing that, when we are investing in companies, we really are keen on companies that are going to drive employment, who have good practices in terms of environmental practices, and who also have what we call a social conscience. As a matter of fact, last year Sygnus worked with a number of its portfolio companies to do a very important corporate social responsibility donation to not the mustard seed to the St. Patrick's Foundation. We partner with our portfolio companies to, I think we raised over $1 million to make a donation to help out that institution, and we will continue to do those type of ESG activity as an investor.
Okay, to Ricardo, what big opportunities for investments are you seeing being highlighted within the pandemic?
Okay, so from where I said buzzwords continue to play out. So in the technology space, there's certainly quite a bit of opportunities that are presenting themselves there. We see it, as I said, regionally as well as locally, with all the online shopping that's taking place. Everybody is moving towards technology. Certainly, who knew that you could go a full year not traveling and having virtual meetings? So within the technology space, there are opportunities. Another big area for us and within the entire Portland group is looking at healthcare. Healthcare is developing right across, globally. You see more developments taking place in healthcare, a lot of investment going towards healthcare. And if you look with the baby boomers getting older, certainly, you see a lot more activity taking place in the healthcare space. So there is opportunities that are presenting themselves within the region in healthcare.
To Xander, how do PE players such as Chukka deal with currency exchange differences across the Caribbean market and not let these issues eat too much into the margins
How do PE? Sorry, I didn't hear.
Sorry, yes, how do PE players such as Chaka?
Yeah. So we manage foreign exchange risk by trying to match the currency that we operate in and collect the majority of our money is in US dollars. So many of our facilities are in US dollars, and so once you match that correctly, or it's pretty much in balance, you can take advantage of some hedging with the Jamaican dollar, but generally we do that through balancing what we earn our money in, and then we borrow in that same currency. So that mitigates the risk.
Tiberis, why do you think real estate was able to do so well during the pandemic?
Let me correct that. Real estate did. You mean why construction industry remained relatively robust? Yeah, I think that's probably what the person mean, because real estate, different parts of real estate did badly. You know, I mean malls and office. Investment in office buildings did badly, right? People either renegotiate tenants and so forth. But areas such as logistic, we're talking about warehouses and so forth, did very well, right? Call centers, those areas did well. In Jamaica, we continue to see residential real estate doing well. And the main reason for that, in terms of Jamaica, is that interest rates are still relative at all-time lows, and the mortgage environment is very competitive. There has long been a shortfall in housing in Jamaica anyway, so even though we have a lot of inventory in certain segments of the market, there are other segments of the market that there are still pent-up demand. In let me say resort area, meaning condos on the north coast, etc., those continue to do well because the buyers for those are not only local investors but also international investors. So you have a much wider market, and we all know that globally interest rates are even lower. Of course, on the logistics side, the whole world and the expansion of the value chain in terms of logistics and supply has been growing phenomenally. So, a lot of businesses just transition into e-retail or e-commerce, and they need warehouses. However, we expect to see commercial office building rebounding in the near term as the economy transition to a balance of work from home and back to sort of typical office building. So there will be a balance. That's our outlook. So we expect to see that sector, and of course hospitality sector rebound.
Okay. And our final question is back to you, Barris. What is the next big thing for Sygnus?
Yeah, that's a great question. I think the big thing, there are a number of big things for Sygnus, right? There are a number of big things. And one of them we spoke about earlier this year at the Jamaica Stock Exchange. I won't sort of say much about it, but it is to list our real estate fund. I already said that that's a big strategic goal. The next big thing, of course, is to execute our development on Belmont. We recently announced that development, very modern office building, almost 80,000 square feet. So that's a very important project for us this year. Outside of that, we will continue to grow our three alternative funds: private credit, private equity, and of course real estate, and sort of expand our footprint across the region.
Okay, so I think that's it for the Q&A segment, and we have come to the end of this morning proceedings, and I want to thank our viewers and listeners in cyberspace for tuning in and to make this webinar a success. We invite you to follow us at Sygnus on our Instagram and Facebook and LinkedIn pages, and to continue to enjoy the Sygnus difference. goodbye again, and we look forward to seeing you in the future, where we will have much more interesting and topical issues to discuss, and where we can interact and share the views. And as we at the CFA Institute says, the idea is to improve our capital markets, improve the integrity, and ensure that financial literacy is widespread, so that all the players, whether it be investors, fund managers, companies alike, can enjoy and reach their goals. Thank you again, and we look forward to seeing you in the future. Thank you.